I'm being told by our editor that you didn't use diatribe in the right way. I think we're going to go back to your Florida education to blame on that, but we'll put it in the editor's notes afterward. I'm not sure you actually know the definition of that word. You sounded good when you said it, and I'm sure that most of our listeners didn't pick up on it. But I wanted to make sure that we are factual, if nothing else, as a show. So, um, I so something
accuracy has suddenly become important to us.
It's incredibly important that we go through here. The half-assed internet research we did to prepare for this. I wanted to make sure that our viewers knew that Frank got that word wrong.
You're listening to Let Me Speak to a Manager with Frank Cava and Ian Mathews.
What a crock of shit.
Yeah, that was hot mic, Sam.
You can't say God on the air.
Don't worry, nobody's listening anyway.
Do it live! I'll write it and we'll do it live!
Frankie!
Ian, you son of a bitch.
What's up, man?
How are you?
It's a fine fall day.
It is nice.
I'm excited to hang out. I'm excited to talk a little real estate with you today. We got a lot of topics on the docket today. Frank and I are talking about, we have like 7 different episodes we've been fighting over which ones to do today. So it could monopolize our entire day, or we could get lazy and go for Anita's breakfast burritos as soon as we finish this one. We haven't figured it out yet.
Sounds so good.
We instead of prepping, we spent 20 minutes. We got off on a tangent of how good Anita's breakfast burritos are. And now that's all I can think about.
I had breakfast out this morning. So I asked my wife, I'm like, hey, I got a meeting with this guy. He wants to meet me at 8. I got 2 kids under the age of 3. So I usually do not have meetings before 9 because you just never know what's going to happen. Yeah. Of course, my youngest woke up early. He shit himself twice. Like he had a blowout up to his ears. She's like, deal with this. I'm like, it was photo day for Max. So I took his shirt off. So he was eating breakfast at the table with no shirt. He had eggs all over him from nipple to navel. It was great.
It's a fine start to your day.
It is. But then I had breakfast out, Ian. I had sausage links. They had links. Very excited about that. So like your breakfast burrito, I had sausage links. That was very, 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 it was a great morning. Lots of coffee.
Frankie and I have both been involved pretty heavily in the real estate business for 20 years. And so from time to time, I see something in the Wall Street Journal. I'm old school. I still read the paper edition. So I have to go look it up online to send it to Frank. But I'll see something from time to time. And usually all I write when I send them a link is or look out below or something like that, because I get flashbacks to things that I saw in 2005, 2006 that we lived through. And Frank and I had very different perspectives back then. And, I think we've been through a little more, but I saw an article just a couple of days ago that I flipped over to Frank, and it was one of those articles. And I don't think a lot of people read it the way I did, but I spent a decade underwriting mortgages. So I looked at the way the mortgage market works, what an investor of mortgages who are purchasing mortgage, what they would care about, what the inherent risks are. And so this article talked about a theme with millennials right now. So first and foremost, since 2014, millennials are the largest share of home buyers. I don't think that's news, but also I think people still are in the process of calling millennials kids, and that's really wrong. The oldest millennial today is 40 years old. So I think most people get millennials mixed up with Gen Z, which that's not who millennials are. These are adults. They're raising kids. They got jobs. They've been in the workplace for 10 years. They're not kids going to festivals anymore. So, but what they were talking about with millennials is a trend where millennials are buying houses together and not married folks. These are friends that are purchasing together. So from 2014 to 2021, Frank, the number of co-buyers with different last names increased by 771%. So these are friends who are buying houses together that are not married. And so they're going in on the down payment. They're going in 50-50 arrangements. They're getting the mortgage together. Both of their names are on the title. Both of their names are on the mortgage. And a big chunk of this spike really even took off after the pandemic. So, there's a guy in this article from Fannie Mae that talks about, during the pandemic, people have been renting and they want more space. So they looked at, maybe if I've got a roommate now and I'm renting, why not get a roommate and go buy a house together? And there are a bunch of millennials that are quoted throughout this article that are just saying, I can't afford a house today. I just can't. Places like San Francisco, DC, New York, big cities, they're just getting priced out. The price Schiller index is off the charts, and we'll talk about that in a minute. But what they're saying is, I couldn't afford a house if I wanted by myself. But now I'm shopping with a friend, and every time I see a price, it's simple. I just cut it in half. I see a $500,000 house. I say, oh, it's $250,000 house. And when I read this, I'm looking at this from a risk perspective. I'm looking at this from an underwriting perspective. I always look at every mortgage. I've always looked at is, what if you lose your job? What if you move? What if you have kids? What if that's a good underwriter thinks that way. They look at it and they say, all right, you're commuting 2 hours to work. What happens if gas prices go up? What happens if you get sick of commuting 2 hours to work? Are you just going to walk on my house? What I see with this, the big issue I see, that most of these, almost every quote in there is tied to home prices and tied to making it easier to buy. But I didn't see anyone say anything about what will I do if we're in a housing bubble and the home price drops from 500 to 400,000. No one's talking about that. Like, sure, you're my friend right now. Neither of us are married. No one has kids. But if that price drops 50,000, 75,000, 100,000, just like it did in 2005 and 6, and both of us get married and both of us have kids, what's happening to that house? Or are you so good of a friend that when you lose your job and you don't have income for 2 years, am I going to pay your mortgage and get myself in more debt? Because millennials are already chock full of student debt. So when I see it, I see that as a major risk happening in the market. I don't see it as this positive of, look at all this new demand millennials are buying together. I see it as folks aren't really looking at the downside, which is one of the clear signs that I saw in 2005 and 6 when people were buying, is people were not thinking about what if the prices don't keep going up. And so the question I'm posing to you, Frank, all day long, you buy real estate. So, are we in the makings of a real estate bubble? And if so, what are the things you look at as someone who goes and, what are you purchasing now? 200, 300 homes a year? So as someone that goes and purchases that much residential real estate, what signs are you looking at as an operator?
So the way that I want to start this is like this. I've been hearing for about 10 years that we are about to enter into a recession in real estate. Everybody thinks it's going to come crashing down. So what I think you have to be mindful of is, what type of real estate is it? Why are you utilizing it, or why do you want it? And, where can you speculate smart? So there's a lot to unpack in that. Like what Ian's talking about is the fundamentals of real estate. So real estate, especially homes, are typically owned by individuals. Now, we're going to talk about a ton of this stuff, but like Wall Street got involved in the market, and it's hard to tell exactly the numbers. Like I'm looking on the internet right now, and there's somewhere between 300,000 owned by Wall Street versus Blackstone, or their subsidiary, which is Invitation Homes, owns 300 houses. But basically, institutional investors, professional investors, own somewhere between 2 and 5% of all the home building, all the home stock that's out there. So it's a small segment of market. But most of the people who own homes are individuals. Ian and I 15 years ago were out having a fun time in DC, drinking a bunch of beers, talking. And we had an epiphany that the two things people spend the less time thinking about and they're really emotional about their decision making, and it's where they go to work and and a house purchase. So what people do in a lot of instances, they're not strategic about buying a house. They fall in love with it. It's the reason why the model home is gorgeous. The builder has this beautiful home with furniture that's way nicer than you're going to be able to afford to put in it. And they speak to a sense of emotion of you could move into this home and live like this. And the only way you're going to move into that home and live like that is if you max out your credit cards, you hit the lottery. But they don't tell you that. What they want you to feel is like this beautiful sense of arrival. So it sparks a sense of emotion. What I think happened on that article, Ian, that you just quoted, people that were millennials, they're single, they're living in densely populated areas, they're living in apartments, and during COVID, it's awful. You can't go anywhere, you have no space, you're confined to X number of square feet, it's really small. I am very fortunate. I live in a 77,000 square foot home. It still felt like a jail cell during COVID. So if you lived in an 800-foot apartment as a single millennial, it's like, why not buy a house with a friend, have a backyard, live in something that's mine, have some room, because now you're working, you're sleeping, you're socializing, you're doing everything in that house. So that statistic makes a lot of sense to me. But what isn't being talked about is what Ian said. 3 years from now, 5 years from now, 10 years from now, you need to move. So is there a flood of inventory that comes to the market? The other thing is builders in Wall Street now have tons and tons of build to rents. So there's all this inventory that's sitting there, that's single family inventory, that if they decide to all liquidate at the same time, there is going to be an oversupply of housing and it's going to flood the pricing. So Ian and I both went on 2 diatribes to start this off. What I will tell you is this, and this is the most important fundamental. You need to understand what you need from that real estate. Do you need shelter? Do you need a place to live? I think it's always better to own than to rent. Number one. Number two, are we in a housing bubble? I don't know. The only time I'm going to know is after it happens. So as we're going to talk about in this episode, what are the things you can do to give yourself some protection and to give yourself the upper hand? So if things do change or something does happen, you have a soft landing or you're in a really good position.
I'm being told by our editor that you didn't use diatribe in the right way. I think we're going to go back to your Florida education to blame on that, but we'll put it in the editor's notes afterward. I'm not sure you actually know the definition of that word. You sounded good when you said it, and I'm sure that most of our listeners didn't pick up on it. But I want to make sure that we are factual, if nothing else, as a show. So,
Accuracy has suddenly become important to us.
Incredibly important that we go through here. The half-assed internet research we did to prepare for this, I wanted to make sure that our viewers knew that Frank got that word wrong. So I think something you said is important. One, you got to live somewhere. And I totally agree with you on what is driving people buying and trying to grab something bigger right now. And I felt the same thing in COVID. I have a big house and a big yard, and it wasn't big enough. And I wanted twice the yard, and I have a huge yard. I don't even know why I wanted it. I just wanted to be away from people. I wanted more rooms that I could go escape to get away from people. So I get all of that. And a lot of that was driving it. And COVID also is a big reason that drove a lot of the prices up, because you've got all kinds of supply issues. So you've got this demand of people saying, I just want something. And as prices go up and up, there's also the mad dash of, if I don't get in now, I'm never going to get in. Which I think a little bit of that is happening in the stock market as well. So whether it's a bubble or not, I'm with you, Frank. So let's just go out on the record and say neither of us know shit. We don't know whether it's a bubble. We don't know whether anything's going to crash. This could keep going up for 5 years. It could flatten for 5 years. It could crash next year. Like there's
so I want to interrupt and I want to do something very fast. and it's going to take a minute or two. How did we get here? So I'm going to go back to the Gulf War in 1990. There's a bunch of things that happen negatively. If you want to get into the research, you can look at it. We go into a massive recession. And then in around 92, 93, the home building market starts to go up. It's going up. And in about 2001, we're starting to see signs of a recession. And then September 11th happens, and the government makes money really, really cheap. And when we should have gotten into a recession, what ended up happening is the government made money cheap to keep kind of, mentality and consumer confidence up. So what happened is, instead of going into a recession, we rode further for about 5 more years, depending where you were in the market. Somewhere between 2005 and 2008, home prices continued to go up. So 1990 to 2008 is about an 18-year window. And then what happened, instead of there being a soft landing in 2001, September 11th caused a huge spike. And with that huge spike, what ultimately happened is, when there was a reset, it was hard. And there was a massive pullback. So from 2008 to 2010, plus or minus a couple of years, depending on where you were in the market and how you want to look at it, prices and everything softened tremendously. By 2011, 2012, what started to happen was things were cheap. They were similarly priced to what they were like 20 years ago, but there had been inflation. The cost of the sticks and the bricks had gone up, but the pricing of the house was the same price. So there was a major inefficiency in the market. And what this means is that people looked at it like me. I was buying houses for $18,000, $20,000, $22,000, or if I went to Lowe's and bought all the material, it cost me 75 to 100 grand. So I'm like, this is stupid not to buy this house at this price. And what happened is, by about 2015, the market had stabilized, and then the market started to go up. But not too dissimilar from 2001, when Ian and I couldn't see each other during COVID, but during March of 2020, we're on the phone and we're talking about capital, mortgages, the underwriting. We can get really complicated on this, but we'll stay high level. When we're talking about that, nobody wanted to buy mortgages. Every mortgage buyer out there needs to be a capital market that buys securitized mortgages, or mortgages disappear. So nobody wanted to buy it. So Ian and I are like, we're effed. This market is screwed. People were looking at it and saying, this is what's going to happen. Like, if you don't close by March 31st, if you go into April, we're no longer going to honor your loan. Like, these were threats that people were making. So while all this was happening, the government looked at this, and before PPP or anything else with CARES Act, any of that shit happened, what the government did is they started to buy treasuries. And the reason they bought treasuries, and they're still doing it, is because they needed to add some stability to the market, or this would have dried up completely and we could have gone into a catastrophic situation. So 2001, 2020, in both instances, something crazy happened from left field, 9/11, COVID. And in both instances, the government reacted with really cheap money that propped up the home building industry. What Ian is telling you are things that we relate back to from 15, 20 years ago. But
here's where I'll disagree with you a little bit on that. There's nothing unique the government did in 2020 that they haven't been doing since 2007. So the government has been buying treasuries every year since the great financial recession of 2006, 7, 8, when the big crash happened. They've been buying mortgages, they've been buying treasuries, they've been buying every financial instrument they could get their hand on. And it's driven this huge bull run, which means rates have tumbled and tumbled and tumbled and tumbled. There's nothing unusual about 2020 other than the fact that they did it during a super hot market right when COVID hit. So there were all these really positive things going on in 2020. Then COVID hit, which hit like maybe 2 or 3 markets really hard, but a ton of other markets kept flourishing. And then they just flushed even more. So all they did was triple down on something they've been doing. So I don't think there's anything new to what they did.
But no, it's not new, but the amount was incredible. The amount of money they were buying 25 billion a day in treasuries for like 3 or 4 months, when that used to be what they would buy over the course of a month. So the amount, so two things happened. The market
They
gets
just kept doing
stabilized.
what they were doing. They just did more of it in my opinion, in a market that didn't really need it. They could have targeted a few industries that were in trouble, but there were some industries just killing it that are now getting money. They don't even know what to do with it. So they're just buying their own stock and doing other things.
So with governance comes sometimes an overstep because you're trying to regulate and it's very hard to be specific. You're shooting a water hose at something that needs a finite amount. But what I want to drive at is this: during COVID, you couldn't do shit. You're locked in your house. We're not doing anything. We're watching Netflix. The only thing people could do for a hobby was go shop for a house. The house is empty. You can get out. You can look at it. You can wear a mask. You can go in there and you realize my house is getting too small. So what ended up happening was capital came down and the market was open. The cost of the mortgage dropped and the demand soared. Plus, it was the only thing you could really do from the standpoint of socializing or entertainment.
And you had
So
the animal spirit. The other piece of that is you had the animal spirits of that. Just as all these people are going out looking with low mortgage rates and excited, there's no inventory. You can't find. You go to a builder and they have waiting lists because they're burning through all their inventory. They're scared that they're going to run out of lots. Like that's the big risk right now of buying a home builder stock. Will they run out of lots? Because everyone knows they can make money on the next 5 years worth of houses, but what they're paying for new lots is outrageous. So I think that's the reason why home builder stocks have kind of plateaued. Is I think Wall Street's starting to look at it and say, are you going to make money on those lots you bought this year in 5 years? Because we think in 5 years, this market's not going to look quite the same as it does today.
And supply chain, everything closed. So we have a house that we're going to list at $900,000, which is an expensive house in Richmond. And it was ready for the market 3 weeks ago. We didn't list it because you don't stick a $900,000 house on the market without a range. We couldn't get it. We ordered a double oven 6 months ago and it kept getting delayed. We couldn't find the double oven. So it's like we're waiting to go on the market, but we don't have this critical piece of equipment that you can't go to market without it. So everything's more expensive. Subcontractors, employment, all of these things are costing more. But something did fundamentally change, Ian. Inventory was about 5 months. A healthy market is about 4 or 5 months of inventory. Inventory dropped to a fraction of 1 month during this huge boom. But right before the vaccine kind of came out in full swing, March, April, May, if you put a house on the market, you get 25 offers. No shit, 25 offers, escalations, things are going for way over market. But when you could get vaccine, the world kind of opened up again, people were like, I've bid on 8 houses. I haven't won any of them. I'm tired of this. I'm going to go out and enjoy life, and I'm going to continue to live where I live or rent. So the market has already come down some from this euphoria. Now, what's crazy is part of that
euphoria, part of that enthusiasm that comes down though is prices are up 27% year over year. So I think if I started a year ago, I had one price in mind, then I stretched myself a little bit, then I stretched a little bit. Now I'm like, this is just dumb. I'm going to go have fun. Everything's open. I'm going to go spend my money somewhere else.
You're prudent. Most people are more emotional in their purchase and you already live in a great house. But interest rates have dropped enough where your price shock is pretty similar to what it was like, even though it was 27% different in pricing. But people just got so much fatigue around putting in offers and not winning. It's you think you're moving to this house and you lose it 8 to 10 times. You're like, I'm over this. So, but this is critical, and I want to spit this out. What you and I see and feel because of our experience and what we've done, by the time the Wall Street Journal writes an article, there's a gap between reality and when they're reporting it. It could be 30 days, it could be 150 days, but there's a gap in there with what they're putting out there and what reality is different. So if you do want to be good at something, investing, Wall Street's better than Ian and me. There's no question. They see patterns and they can get that gap and they know how to exploit that gap. But if you want to be really good at something, understanding where the market is and where society is and being able to trade in that small space is where there is security and where there is certainty. And it can give you a huge advantage in real estate, stocks, anything else you look at.
So objectively, data, Case-Shiller's probably the best indicator of where prices are. So Case-Shiller in January of 2012, the Case-Shiller index was 134. So that was 8 years ago.
What does 134 mean?
So 134 is just an index rating, a standard index, and it goes back to 1880. Whereas
For
in
those
today,
people that are, but for people who aren't, familiar with Case-Shiller, I just want to kind of give a context.
it's a relative indicator. That's all it is.
Yep.
It's a relative indicator over 100 years that they look at it. Today, that number is 270. So it's doubled over an 8-year period. And if you go look at incomes, which typically drive this, they're nowhere close to double. They're single digits almost, maybe in a lot of industries less than that.
And adjusted for inflation, it's actually down, but the average is about an 8% increase over that period.
But you have lower rates than you had then, which gives you more buying power.
Yep.
And a lot of this price index is just driven by supply. There's not as many contractors to build houses, not as many builders out doing this kind of work. People can't get lots. They're lot constrained. So there's a lot that's going on there, but objectively, you've got a double in pricing. And 2012 was not the 100% bottom, but it was pretty close. So that was after a big drop, obviously. But even if you go look at, Frankie, if you go look at the peak of pricing in the housing bubble, 2006, that was like, we're still up 60, 70% from the peak of pricing when things were really crazy. Now, I always look at this from, so interest rates drives, I think, a ton of it. And we can't keep rates this low forever, but they could stay low for longer. It really depends on demand. But I also look at, is it easy to get a mortgage? And the truth is, it's not easier to get a mortgage. It's probably a little bit more difficult today than it was in just before COVID hit, because people were having trouble securitizing loans. As soon as COVID hit, all these people lost their jobs. Now, all of a sudden, all the government loans, people didn't want those. So it's not like people are out just giving away mortgage money the way they were in 2004, 5, and 6. It's very different.
Let me interject something very quickly. During the housing boom, the average amount of money that people put down on a house was less than 3%. And the average credit score was right around 680. Today, the down payment is closer to 25%, and the average credit score is over 725. So people with 700 credit scores were being drowned out in the last economy or the last boom and bust because of people coming to the table with 500 credits. So if you get into the nuances of this, like a 500 credit score is someone who's almost intentionally not paying for things. So we're in a much stronger economic position today based upon what people have learned in the lending cycle. So we're way stronger in 2020 than we were in 2005, and 2020 to 2021, it's gotten even harder.
Yeah, I like that. And I think if you look at anything, I think the price of bacon is up 18% right now. If you go look at oil, it is skyrocketing right now. Frankie just sent me a link a week ago on a record auction on baseball cards. If you go look at the top prices ever paid for baseball cards, if you look at the top 50, I think like 45 of them are in the last 12 months. It's insane what people are paying for baseball cards. Non-fungible tokens, which are pretty much, these are protected JPEGs in the blockchain. These are brand new works of art are going for $300,000, $400,000, $500,000, which they're literally like PDFs that you can't get your hands on.
So let's get into why. COVID basically attacked weakness. If you're physically weak, it killed you. 1 million+ people have died in America alone. And if you are physically weak as a business, it's killed you. But if you were a college educated person, if you were someone who had a good job, a good career, a good business, you went through some lumps, but the government gave tons of money in PPP, CARES Act, all this other stuff, and you couldn't go anywhere. So you couldn't spend your money. Like, you're basically just spending money on DoorDash and Amazon, and that's it. So what happened in the last 18 months is the amount of money in people's accounts has skyrocketed. Savings accounts have gone up. Even though we hit almost 20% unemployment for a very short period of time, savings accounts went way up. So what happened is there's all this money sitting on the sidelines, and things like bacon, baseball cards, NFTs, real estate. People are like, where do I put my money and get yield? Ian and I have talked about his commercial deal. He bought that commercial deal at an 8 cap. He sold it at a sub 6 cap, which in English means the value went up by like 25% in a 3-year period of time because people want return on their money. So I would imagine Warren Buffett is probably sitting on a bunch of cash and waiting for some segment of the market to falter, and they will poach it. But what emotional people, most of us do, is we see everybody in our friend group buying new houses, so we run out and want to buy a new house. In my world, what we do as a business is we acquire real estate and we buy it typically off market. So I don't go through the MLS, I go directly to a seller. And my disposition strategy, how I sell it, is usually about 50% fix it and put it on the MLS as a renovated home, and 50% we wholesale or just sell the contract. Now it's like 80-20. 80% assign the contract, because there's so many people who are starved for inventory and are willing to overpay to either flip a house or because they want to just put sweat equity in. The market fundamentals have changed. So we have changed with the market, because the market right now is giving you a quick sale if you can control inventory. And with buying 25, 30 houses a month, we can control inventory more than most in our market. So is there a bubble? I don't know. How do you make sure you protect yourself? Look at the market and take what it gives you. Don't force something on the market. Take it. Wholesale works. Do that now.
So you mentioned Warren Buffett. I think that's a good person to talk about. So Warren and Charlie with Berkshire Hathaway, every time the market looks a little bubbly, and let's be real, the stock market. So Frank and I just went through this before here. So stock market, if you track the price that people will pay for a stock, what they'll pay for your earnings over the last 10 years. So there's a chart, go look up Shiller PE ratio. There's a chart that goes back over 100 years. Only in one point in the last century has the stock market ever been more expensive. Have people been more willing to pay what they're paying for earnings than today? And that was the tech bubble. And it wasn't a hell of a lot more expensive, but we're already currently more expensive than prior to the great stock market crash of 1929, of 1987, of 2006-7 when it crashed. So stock market, let's just say, could it go higher? Of course. Is it really expensive historically based on earnings? Absolutely. There's only one other time where objectively you could say the stock market was more expensive. But does that mean Warren Buffett's selling everything? He's not. Warren and Charlie don't sell when the market is high. What they don't do is buy. They're not buying a lot. They sit and they wait. Like you said, they got this big pile of cash, but they're not selling because, and the way they explain it is always very good. They're not selling because they're not great at timing the market. And they felt this way 3 years ago. And if they would have sold then, they would have left billions of dollars on the table. But they do wait, and they have enough cash to be able to take advantage when they need to. But they don't know what they would, if they sold, they don't know what they would go put it into. And I'm a little bit the same way. If you have a windfall, let's say you bought Amazon 6 years ago and you have a windfall and you have a bunch of money. And the question is, should I sell it? Or I have a property that's done really well. Should I sell it? The question is, what are you going to go buy that could do better? And if your current investment is continuing to make you money, has good cash flow. So what Frank does really well is you don't really buy anything that you're not willing to hold for a long time if your assumption's wrong. And I think this gets back to the initial story that I wanted to talk about. The folks that are buying as friends are not thinking 10 years out. They're not thinking 5 years out, and they are not thinking, what if I'm wrong? They're not thinking that way.
Nope.
And so I think if you're going to buy anything, if you're going to go buy, I just talked to someone the other day that was like, I'm buying baseball cards. And I'm like, okay, how long were you willing to hold that baseball card? Because my old man, my old man's got one of the best baseball card collections in the country. And he was buying that shit in the 50s and the 60s and just sitting on it for long periods of time. So anyone who's going out and buying baseball cards or NFTs or real estate and trying to flip real quick, you better be able to buy at the prices Frank can buy at in real estate. You better be able to have a better eye than everyone on Wall Street who can look at stocks to find some value. Everything in investing is about how long are you willing to hold if you're wrong. And that's how I look at everything. What if I'm wrong? And am I willing to wait it out? And that's why I think, going back to these millennials and now everyone buying, when a married couple buys a house together and they're wrong, they ride it out. They have kids together. They're not forced into selling. They're not forced into moving out, but that's going to happen with a lot of these friends. And when that happens, when they all want to get married and they want to have kids and they want to do different things, or a friend loses a job, what's that going to do to the friendship? What's that going to do to thinking out? When Frank and I get into a real estate deal, we're friends, but we both also know that we're capitalized well enough that if we're wrong, we're willing to be partners for a decade if we ought to be. I'm in this long haul with Frank. Shit, it will be great if our last real estate deal, we flip that thing in 2 years and make a ton of money. But if I got to ride that out with you until 2030, I'm riding with you, bro. Like, I know that. I got in, and everyone who invested with us knows that. Like, if we got to ride with you, you guys are worth riding with, and we'll stick with you. We're not going to beg for our money and pull it out. And we told them can't be money you need back in 12 months or you can't invest. Now, I think we're going to kick ass on this deal, but any deal I do with you, I'm always thinking, if it's got to be a decade, it's got to be a decade. That's just the way it is. We might be wrong on timing.
We bought 75 houses 90 days before COVID, and we thought we were going to be done in a year. Ultimately, we did it in 13 months, but 90 days in, when we told everybody, we're like, hey, we just got a major curveball. We're going to slow down a little bit. We're going to see what happens with the market. We're going to keep collecting rents. We're going to do okay. We might not hit the numbers we had thought, but we're going to be okay. And then what happened is the fundamentals changed. Ian and I have different perspectives on what it was. I think the bond buying was a big part of it. The market stabilized, prices went up. We talked about it. We're like, this may not last forever, so let's capitalize. So what I'd like to do, Ian,
real quick though, I don't want to say I don't disagree with you that the bond buying had something to do with it. My whole point is it wasn't new. They were doing it in a market, in my opinion, that didn't need to throw kerosene on a fire, because they like you said, there were winners and losers in COVID, and the winners were killing it in COVID and getting money thrown at them cheap and more. And so it just was like this big blaze, and real estate was one of those areas that, unless you were in retail space or commercial office space, every other segment of real estate was doing great. And you threw a bunch of cheap money at people that were already in that space, and it just bubbled it up really fast.
So I think we're in unison. The government did throw money at the problem, and they probably threw more than they needed, but they were looking at, holy shit, are we going to go into a Great Depression? We don't want to do that.
So what spaces of real estate can you make money? I think that's probably, if someone's listening right now, is there anywhere in real estate I could still make money?
Okay.
And how?
So I want to do this. I want to explain something, and then I want to give an overview of a cycle, and then I ask the questions and then wrap this thing. But I want to say this first. The first thing you need to do as an investor is you need to look at what the market is doing and take what the market gives you. Right now, it's an incredibly difficult time to buy at a discount, but it's an incredibly good time to refinance. So why do I bring this up? When I bought my first house I built my first house in 2000, my primary first mortgage was 8.5, and my second was 12.5. I had a first and a second. Right now, I'm refinancing at sub 375 interest rates on investment grade product. That is ridiculous. It's 1/3 as expensive to finance a house that's an investment than it was a primary residence 20 years ago. That is something to capitalize on. The time to find cheap material, cheap houses, cheap baseball cards, cheap MFTs is over. That's not the moment. So think about, what do you have and how do you capitalize on it? There are some things that are happening right now that are incredible. Prices are high. But Trump changed the tax law. He's a real estate investor. He changed the tax law to greatly benefit people that own real estate. Capitalize on this. There is all kinds of good stuff. There is bonus depreciation. There's all these things that if you go and focus on it, you can take bonus depreciation now before the tax law changes and carry it forward. Can you find a house at 50, 60, 70 cents on the dollar? It's really hard. But can you buy something at market and utilize these advantages? Yes. Will they go away? Most likely. Did they happen in the 80s? Yeah. So take what the market gives you. Do you have anything to say on that? Otherwise, I want to go into some cycle stuff.
So I love all of that. I want to repeat though, if you are going to get into real estate, I would look hard at cash flow.
Yes.
And because if you're wrong and the market's not going to go up in the next 1, 2, 3, 4, 5 years, or if it even goes down, you need some kind of cash flow coming in from that real estate. I wouldn't be out just buying and hoping I got it the right price and selling. I think just like NFTs and baseball cards, that's a really risky thing to do after a huge run in any asset class. So I would still be looking to buy anything that pays me cash flow, that if I'm wrong, I'm still making money. So my collision centers, I'm still getting a check, a rent check every month, whether the price goes up or down. Now I've got a windfall. They've all gone way up higher than I thought they could have, but I'm not really selling because I'm still getting a check every month. And that's like a salary for me.
When I was taught this, the man who taught this to me said the following. He goes, appreciation needs to be the sprinkles or the cherry. Appreciation is not the ice cream or even the whipped cream. It's just the garnish. So you need to buy with strong fundamentals. And what I'm talking about with the refi side is capital is very, very easy to find.
I love the refi comment. It's so smart and it's so easy. And it's so easy. You're in and out in 30 days. They're making it easy on you. They're just giving away money.
That's it. So that's what the market's giving right now. There's incredible tax. There's incredible interest rates. Capitalize on those. If you're going to buy with edge and think through more than these millennials who are buying houses with people that they may or may not want to be with in 10 years. That's a bad strategy.
You can get a jumbo loan for under 3% right now, like up to $1.5 million. It's insane. It's insane.
It's flipping nuts.
Yeah.
All right. So if you want to become a nerd on market cycles like Ian and me, I'm going to talk about two things. One, there's a book. It is a New York Times bestseller, and I think it won a Pulitzer. 8 Centuries of Fiscal Folly. 8 Centuries of Fiscal Folly. This time is different is the name of the book. This time is different. Yep. You go and you look at it, the subtitle is the fiscal folly part, but they go all the way back to the point where like they didn't have monetary units. They use like rice or wheat to trade. And it goes through cycles and it explains the process. But what I want to talk about here, Ian, just quickly is the real estate cycles. Okay. There are 4 major cycles. There's recession, there's recovery, there's expansion, and there's hyper supply. So it's like an 80s Atari game. Like you can go from the right and you'll end up on the left. The thing's like a wheel, it spins. So you go from recession to recovery, and then you move your way around to expansion and hyper supply. Like we are certainly not in recovery and we're certainly not in recession, but we're probably somewhere between expansion and hyper supply. So I'm going to read to you what defines hyper supply. And the reason that this is relevant is if we are going to go into a recession, which happens after hypersupply, these are the things to look for. Are we going into a recession? At some point, but I don't know when. So these are the things that, like, if you said, what are you looking at? This is what I look at. First, occupancy rates exceed long-term averages. Second, upward pressure on rentals breeds more development. You start to get to a point where you get an oversupply of units, and then it's going to start to negatively impact your occupancy rates. Here's the first sign of trouble: an increase in unsold inventory. We're not there yet. Vacancy rates raise and rents begin to fall. We're not there yet. Wise developers start introducing new inventory, and I put in parentheses, this never happens. So if you start to see these things, this is where you need humility. So in 2020, around March, when everything went to hell in a handbasket, I went into liquidation mode. Ultimately, I had a pullback here in 2020 where almost everybody I know went way up. But what I did is I was fast and I just made really big cuts quickly because I did not want to drown. Was I early? Turns out I was. Did I make it through? Yes. So if you start to pay attention to these things, you can be ahead of the market, and you need to be prudent. You start to see some of these green shoots turn to, yellow or red shoots. You need to be adjusting your approach.
I think also every time I've seen a major market drop, there's been rumblings for years that it's kind of frothy.
Yep.
And there's always people that were 5 years early.
Yeah.
On selling everything and saying, oh, it's a bubble. Because when it starts to look like a bubble, it normally is just getting going. It's just starting when you start seeing the charts that are kind of going straight up. It's normally just getting going. And I don't know. I think selling everything, you didn't sell everything. You sold enough where you would have cash to take advantage of a market, and you did take advantage of the market. So you were smart about what you sold.
I sold my speculative inventory. I did not sell any of I have two different types.
You kept your cash flowing business.
Correct.
Like we were talking about stuff.
And I sold all the stuff with risk.
You got rid of your speculative stuff, and that's fine. You bought more cash flowing stuff so that you still have that kind of coming through. And I sold one of my industrial properties and I put it immediately back into something else that would give me cash flow with you. So I got in, it was like a different deal that I had a little more control over, and it could give me a little better yield. But I'm a little bit, same thing. I think also, Frank, it's worth talking about when the market gets frothy. I don't think that's the time to go start looking for cigar butts, to go start looking for, real estate deals that are dirt priced, that are kind of crappy, that no one else wants. I think the time to look for that stuff is way past. If you're going to be buying today, I would want to be grabbing anything that is, a high quality asset, high quality in any way. So, let's go back to baseball cards. It's never a bad time to own a Mickey Mantle rookie card. It's never a bad time. If you're going to buy that at too high of a price, buy Mickey Mantle. Don't buy LeBron James 3 years ago card that was just made. Probably got a better chance on something timeless. I would say it's the same with real estate. Still location, buying growing locations that are going to do great over the next 10 years. Buy great properties that have solid frames. Buy brick, right? Go back to some of your stuff. For me, I'm still buying stocks. I'm buying a lot of Amazon. I've been buying Amazon since March of last year. Amazon's not going anywhere. I don't give a shit what the media says. I don't care what politicians want to do. Amazon is raking cash, and they're going to keep raking cash. So to me, if I'm buying stocks at a time that's bad, at least I'm buying very high quality names that don't have too much debt, that have a ton of cash on their balance sheet, and are going to be fine in 5 to 10 years. I think it's the same with real estate. If I've got to buy this, am I willing, will I be happy owning this in 10 years? I think of real estate and stocks the same way. I don't buy stocks thinking I want to flip this in 6 months. I buy names that I would be happy owning in 10 years.
So I'll attack this from a slightly different perspective. Is now a good time to quit your job and become a real estate investor / speculator? No. We're 12, 13 years into a bull run. There's a lot more downside coming than there is upside.
You probably missed it.
If you asked me for my opinion of give me your best opinion, if you're going to quit your job and start something new, start when it's at its absolute lowest, because it's going to give you the most time to figure it out and have the wind at your back for as long as possible. However, let's say you're listening to us and you own 20 rental properties, good rental properties, you're doing well. You haven't refinanced them. You haven't turned them into an ATM machine. Owning and managing 20 rental houses is a pain in the ass. No other way to slice it. But if you were to trade out of those at high numbers, 1031 into an industrial building, with a 20-year lease on it with GE or Gerber or Amazon. And you might have slightly less return, but you gave yourself a better opportunity and a better asset class. Like, to me, now is the time to buy stuff that you want to own forever. Like Ian said, like, you know, you're going to own it for 10 to 30 years. And if you overpay a little bit, is it really going to matter 30 years down the road? Because it's such a, like, wow, what a good buy 30 years ago. When Warren Buffett bought Coca-Cola in the 1950s, it looks like a pretty damn good buy 70 years later, because Coca-Cola went from having Coke to 700 different beverage products. And their market cap went from something minuscule to something enormous.
Yeah.
So that's the time, to me, to be smart. Take advantage of low interest rates and trade out of something that's a pain into something that's great.
Frank, I'm just going to use stocks again one more time on this, because
That's your world.
Warren Buffett has he's got rules that he's Ben Graham, and he likes to buy things at a serious discount and all that. But the truth is, in my lifetime of investing, there haven't been a ton of periods of time where there were great buys. Like, stock market's been pretty hot since 1980. It's just been straight up. So I've missed on a ton of good companies because I've looked at them and said, man, that's pricey. I think 2007, I'm looking at Google and saying, like, God, 150.
You and I talked about it
for Google. And, the truth is, it's pricey for a reason. Like, when some things are priced much higher, like right now, Microsoft's priced really high, Amazon's priced really high, Apple, all those big names are priced high. But if you go look at the companies, they're raking cash. They have these war chests of cash, no debt. Their revenue is growing 30% a year. There's a reason they're expensive. And maybe you overpay for them today, but if you just wait on it a few years, they won't look that pricey anymore. And so I know I'm saying this in a lot of different ways. If you're buying today, buy really high quality assets without a lot of risk. Don't be looking for deals today, because the deals, when a recession hits and there is a crash, right? This time is different, tells us that happens about every 15 to 17 years. There's some kind of financial.
Depending on the market cycle, yeah. Real estate's 18.
Yep. So when that happens, which we don't know when it's going to happen, you don't want to own the cigar butts. You don't want to own low quality stuff that was still cheap when everything else was priced. That's the stuff that loses 90% of its value. That's the stuff that goes to zero, that goes bankrupt. You want to own high quality names that maybe in a crash, they drop 40%. But then they go right back to where they were before. That's what you want to own, is the high quality stuff that will still be in demand after people wait out the recession.
So there's an incredible quote by Jerry Jones. For those of you who don't know who Jerry Jones is, he is the owner of the Dallas Cowboys. And Jerry Jones said, I've never been disappointed for something that I have overpaid for. It's all the things that I bought at a discount that I realized why they were priced at a discount. And to put this in perspective for you, in 1989, he bought the Dallas Cowboys for under $200 million. I think there's different reports in here that I'm looking at. I thought it was 190, but it was under 200 million. It's worth $6 billion today. People said he overpaid for it at the time. When he bought the franchise, there was either 28 or 32 franchises in the NFL. They've expanded a little bit since. But the point of the matter is, he overpaid for an incredible asset. He's owned it for 4 decades. And in the time, it's gone up at a factor that is unfathomable. And because he wanted to be in the space, he wanted to own it. He knew it was an incredible brand. And he wanted to have participation in it, like Ian talked about with Amazon stock, like I talk about with my stuff. I want to be there. I like to be there. I understand it. Will it go up? Will it go down? Of course. But I'm in for the long haul, and I'm in it for all the right reasons. And because of it, it's not a speculative play. And because I've been at this for 20 years, I'm fortunate enough where every decision isn't make or break for me. Like, am I Jerry Jones rich? Of course not. But do I have a little bit of cushion because I've earned it? Yeah. So I can be slightly wrong. I could be a little bit early, and I can still have runway based upon the fact that I've had a good body of work where I'm right a lot more than I'm wrong.
Yeah. And I don't, if you're sitting there on a house that's up a few $100,000 and you sell it, what are you going to do? You go rent? Do you have a family? Then that comes with its own stresses of having a landlord and not having long-term stability. Are you going to go buy something else? Because that's going to be just as overpriced as what you just sold. So there's not a lot you can do with just your house. If you are in a housing bubble, usually the thing to do is just ride it out. Just like Warren Buffett and Charlie, they don't sell, they just hold and watch to see what happens. And over time, they're usually right.
So let's circle back to the beginning. Ian talked about a statistic where it had gone up by 700 some odd percent. It was mostly due to millennials. What I will summarize is this: with every investment you've ever made, you make your money when you buy, not when you sell. More specifically, you make your money when you buy, you realize your profits when you sell. Think long and hard before you buy something. Do I want to be in this for a while? What is the reason I'm getting into it? Am I being emotional? Am I participating with everybody else? There's a great saying: when everyone is greedy, be fearful. When everyone is fearful, be greedy. Right now, the real estate market to me is everyone's looking to be greedy. So it seems to be fearful. For people who make their living strictly on real estate, I need to continue to be in business. So I have to be very smart with what do I purchase? How do I purchase it? What am I doing? And I've talked to you about how I've offloaded some of my risk by wholesaling. So I collect a lot of rents on, houses that qualify as shelter. And a lot of our marketing dollars go directly to immediate cash. And that's how we've offset this. When the market starts to change and inventory starts to change, we pivot. So utilize that the way that you see fit inside of your lives.
And now is not the time for Frank to be value picking and going and finding the diciest neighborhoods possible. This stuff that's been on MLS for 2-3 months. If it's on the MLS that long right now, that's not what you want to own. Because if the recession does hit, what is that going to be worth? If you couldn't sell in this market, dear God, right? So you have to stay in business, sure, but you have to continue to find good assets that'll work in any market, whether it's good or positive. You can't buy based on today's reality. Good chat. So to answer the question from this episode, is this a housing bubble? Hell if we know. And I hope that both of our diatribes have proved that out over time.
Clearly.
I probably used that wrong too, Frank. Good seeing you, buddy.
Always a pleasure, Ian.
All right, man.